Paul says, you need some clarification on weekly naked put management. Would you automatically cover the positions once the strike is tested? So earlier we discussed the pods and we discussed the trade picks, the covered calls, naked put, monthly and weekly positions, the bull put credit spreads as well. So Paul's question is related to, I don't even have it here. Let me add naked puts, Paul. There we go. And yeah, I'll go weekly picks of the day. So this weekly picks of the day view that's available is based on Ernie's extensive testing into monthly and weekly naked puts, monthly and weekly covered calls, and I did the bull put credit spreads, of course. That represents about 15% of my trading portfolio. And after running about 55 different iterations, stock criteria, option criteria, range in the money, range out of the money, market conditions, and so forth, the results that you're seeing here, and this is a static view, I want to remind everyone of that. The quick view here of weekly picks of the day is only updated once per day. I can see the updated trades anytime I go into the search tool if I'm on the delayed service or the real time, because the exact search criteria that's being used to find these top 3 positions is the same criteria that's in the search for weekly or monthly naked puts. You just see a more updated view. And you see some basic discussion here about what's being looked for in the criteria. And of course, high return will generally mean high risk. For biotech and high return, consider a 10 to 20% OTM protective put with the same expiration as the sold option for insurance. So that's one thing to consider, Paul. But the rest of Ernie's base approach here is described right in this view. He talks about the testing goals, what he was looking for to accomplish with the weekly naked puts, the testing period and how that panned out, how it was done. Monday at 3 p.m., testing and actual trading were done. Well, the closing prices were done on Monday, but the actual trading, the orders would need to be put in the afternoon. That's what he did when we started actively testing this. 106 trades, positions were open 4 days, blah, blah, blah. And, this test was just using $100,000. Now, in that discussion, let's see, I'm sorry, up here somewhere is where he met. There it is. None of the positions had earnings due during the week. We're looking for no positions right now. There's no special stock list was used. Each position had a stock price loss limit at 7% at the close. That's exactly how Ernie approached it. That's how he does it. That's how he did it when he back tested it. But then when he actually started trading it and he tried it, what about 5%? What about 3%? What about 8%? And he found the best results came at this level. Okay. Now, of course, so he said, here, 15% of all trades resulted in hitting the stock loss of 7%. This improved the returns. So if you used no stop loss, it was worse, much worse. And if you used a 3% stop loss, you closed out of too many trades that would have been profitable. So this was the sweet spot during that testing period and during his trading period for the weekly naked puts. So your question, would you automatically cover the positions once the strike is tested? No. He'd open the weekly naked put. He'd set a 7% stop order from when he entered the trade from the current stock price to 7% below the stock price. If that's hit, you just exit the trade. The picks of the day are designed to be not rolled, not managed, not adjusted, not converting to a butterfly, not converting to a condor, not trying to do anything special. Place the trade. Expectations are in the markets we're expecting, but even in varied markets, you can see over this testing period that the results, of course, were 25 losses, so about a 76% winners, with an average return of 2.1%. Of the 25 losses, or the 25% losses, 15% went below the stop order 7%. Others might have just been a 1%, 2% loss haul, or so on. And this resulted in that 47% return over that 53-week period. And of course, in different markets, it does better. Some markets, it does a little bit less, but the return ratio stays about the same. So weekly naked put management, would you automatically cover the positions once the strike is tested? If I was doing this in my personal account, with a significant portion of my personal account, I'd follow exactly what Ernie said based on the testing. If I saw something too high, I would just either avoid it and move to the new position. A biotech stock or something along those lines, Paul, that just stood out, says, oh, your weekly expiration is a 10.2% return. Ooh, something that's coming up there. Phase 2, phase 3 drug trial, something that you can't avoid with earnings or ex-dividends dates. You got to research that a little bit more. Let me just walk to the next one. Or I might use that protective put 10% lower than the strike that's suggested. But normally I just walk away from it personally. But the other two trades I opened, hey, 2097, I'm selling the 20 strike put here, 6% potential naked yield. But you know what I'm going to do? I'm going to put a 7% stop order from this point. Okay. And HIMS, put a 7% stop. If the stock hits that, I'm just closing out the trade regardless of what the loss is. That's what the testing was done. That's what the trading style was done. So I know we talk about other ways to manage a naked put. That, when the stock reaches within 1% or goes below the short put strike price in a bull put credit spread, 1% in a bull put credit spread, you might look to move, adjust, or edit the position. That's for that strategy. For the weekly picks of the day, for the target goals that Ernie set, what he accomplished, and what he found that the 7% stop from the stock price when you enter the position was the best, Paul. That's the best way I can answer your question. If you're more comfortable, if the stock reaches within 1% of your short put strike price, if KC here drops down to 2045, 2040, for example, that would be 2%, wouldn't it? But if it drops down to 2020, 2025, and you feel better looking to maybe roll or adjust the position, that's on you. What Ernie's approach was here, again, right there written out for you, 7% stock loss. If the stock hits 7% stock loss in the time you opened it, that's when you're going to look to maybe get out of the position directly. No management, no rolling down to a lower strike price, hoping the stock's going to come back up, but it keeps dropping down. You keep rolling down, and now you're 8 months out in time at a put strike on a $20 stock that's at 12, and you're just hoping that it comes back up. Don't want to get caught in that trap. It's okay. So remember, you took in some premium. Your put was 2, 3, 4% below the stock price. You probably have a 5 to 7% break even to begin with. So even if it drops here and it costs you more to buy back the put, the loss might only be comparative to the cash secured amount, 1, 2, or 3% on the position. Just get out of it and move on the trade.